Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So obviously, market volatility is back in US and international equities to some extent, but defensive equity ETF flows for the past couple of months, and especially the past couple of weeks, has really jumped up. People are starting to flow into the more defensively positioned ETFs, and it's near an extreme. Let's talk about the implications of that. Number two, that sentiment, it's mirrored by individual investors from surveys that we observe as well in terms of the amount of bearish investors out there reaching its highest peak since the past several years. And then finally, when we look at the yield curve, Fed is on the stage, right? Perhaps several rate hikes in 2022, the beginning of a tightening rate cycle. Well, the yield curve is starting to invert. That is, long-term rates are not going up by as much as short-term. Let's unpack that just a little bit. So on the chart here up top, we have the S&P 500 index. You can see a little bit just recently dipped below 10% peak to trough decline, closed below the 200-day moving average, slightly above it right now. But on the bottom, take a look at the past 65 days, a rolling 65-day sum of ETF flows to defensive ETFs. So what do I mean by defensive ETFs? These are treasury bond-related ETFs. These are consumer staples, utilities, the defensive parts of the equity market, along with low volatility ETFs, ETFs that focus on the low risk parts of the market. Well, people have been getting more and more risk averse over the past couple of weeks, especially during the past week as the markets declined quite significantly, and it's nearing an extreme. Why is that important? The last couple of times that it's reached this extreme, back during March, April, May of 2020, after the pandemic bear market, and back during the fourth quarter of 18, when of course we bottomed Christmas Eve and had that incredible rally in January. So not the best short-term timing tool, but hey, sentiment is nearing this extreme level, which we've historically seen at least the last couple times during those market turning points. Now, it's mirrored by individual investors. The American Association of Individual Investors, AAII, puts out a poll to its members on a weekly basis that asks, how bullish, bearish, or neutral are you over the next 6 months on US stock market? As we can see here, jumped up to 53%, highest level in years. Last time it was above 50%, again, back during the post-pandemic bear market between that March through April period. And if you go back previously during that sharp V bottom, we had nearly 20% drawdown by the S&P 500 in the fourth quarter of 18 and the big rebound. So December in that period, again, investors tend to get a little bit skeptical and during turning points, really pessimistic. And that's kind of the environment we're in right now. So it's not a guarantee that things are going to turn like they did during those two reversals, but we need to observe and take notice that, hey, we are starting to see the amount of negative sentiment that we have seen around those other market turning points. And finally, Federal Reserve in spotlight, perhaps March, the first rate hike. Many people expect between 2 and 3 rate hikes. Stronger than expected jobs report today maybe gives them a little bit more room to raise those rates, but take a look at the yield curve. This is the spread between the 2-year, a little bit longer than the Fed funds rate, but it is the shorter end of the curve relative to the 10-year treasury. So when the difference between these declines, that means that yield curve is declining and flattening. And below zero basically means long-term rates are actually less than short-term rates. And perhaps expectations from our market participants is that the Fed is moving too fast. And we're not there yet, like we saw back in the third quarter of 2019. But take a look at what's been happening the past several months. Markets have been anticipating the change in policy by the Fed. We've seen short-term rates increase quite dramatically, but long-term rates have not done the exact same thing. They've been moving up at a slower pace. It's beginning to flatten. Monitor this over the next several months. And if we continue to see it decline, I think that's the market's way of saying we think the Fed is perhaps pushing the gas pedal a little too far, a little too fast, a little too early for the long-term economic growth prospects, something to keep an eye on. And finally, I want to thank everyone for watching. This story made me ask myself, what exactly did I achieve in 2021? Gentleman out of Idaho broke, according to him, 52 Guinness World Records. That's one per week. The best one, in my opinion, he sliced the most kiwis with a samurai sword while sitting on a Swiss ball. I think that's good. I think it is. I don't know. That's kind of weird, but it also is a little bit impressive as well. Apparently, he also did it with grapes. So he did the combo of fruit Guinness World Records. The other one, which was a little bit interesting, was he was able to eat the most marshmallows in a minute. He had a long list of them. All of them were pretty wacky, but neither here nor there. I don't know what his goals are for next year, but congratulations on a successful 2021. And I want to thank everyone for watching, and I'll see you in a couple weeks.